Hi everyone, and welcome to the Buffett and Beyond Research Stock of the Week, and we're going over BJ's Wholesale. And folks, they're up 350% in 5 years, and they are a recession-resistant stock, or have been so far. This is May 10th, 2025. Yes, BJ's Wholesale Club. And remember, folks, if you want to walk on this beach like Jimmy Buffett once did, you've got to learn how to invest even better than Warren Buffett does now. So let's look at BJ's, and they're the wholesale club that operates a warehouse-style membership stores on the East Coast of the U.S., and you all know them, or you know Costco, so they're the same kind of stores. And as of March 2024, the company had 243 club locations and 174 gas stations in 20 states. Largest concentration is, yeah, you guessed it, New York and Florida, two very populated states. And it has 7 million plus paid club members, and BJ's purchases merchandise directly from manufacturers, of course. And at the end of the beginning of 23, it had 34,000 employees. And its initial public offering was completed in only June of 2018. So it's a relatively new company, or actually a newly publicly traded company, because it's been around for a long time. And let us look at the chart of the clean surplus return on equity. And remember, the clean surplus return on equity is totally different than the traditional return on equity, because clean surplus return on equity is able to be compared from one company to another, where the traditional accounting return on equity has to do within the company, and you compare it over time. Time series analysis is what they call it, but it's compared to the company before and last year and next year. But clean surplus ROE is able to compare companies because it's calculated the same way for each company, not for the individual happenings of each company. So it's a whole different type of return on equity which can be compared, and we have put it into practice for the past 22 years now, so we know it works like 2.5 times more than the S&P 500. And remember, over any 10-year period, and this is a Morningstar report, over any 10-year period, 96% of the professional money managers that manage the publicly traded mutual funds cannot outperform the S&P 500. And we've been doing it for a long time using this methodology, folks. Now, retention rate, 100%. That means all the money they're making, they're putting back into themselves in order to grow. Now, the net income growth and the revenue growth are slightly below average, but this company has been doing very, very well and better than the average stock, and we're about to show you why. Now, let's look at, Costco. We got to bring Costco in there, and here's BJ's over here. So we can see when we look at the clean surplus ROE, and now we're projecting out to 2026. We have numbers that'll do that. Not sure if that'll hold. That's a whole year and a half away, so we'll see what happens. But you can look at the BJ's clean surplus ROE, which has been higher than the Costco clean surplus return on equity. Now, I just want to tell you that we have both stocks in our growth portfolio, and both have been doing very, very well. So again, we're looking at Costco, we're looking at BJ's, and we kind of favor BJ's right now, and or have over the years a little bit more than Costco, but we just love Costco. We love BJ's. Now, let's look at the last 12 months. Black line is the S&P 500, and again, this is the last 12 months. And then we have Costco down here at 30%. So the S&P 500 is up about 10% over the past 12 months. Costco is up 3 times that amount, up 30%, actually up a little over 30%. But look at BJ's, it's up over 50% relative to the S&P 10%. So both these stocks are outperforming the S&P 500. Let's go to 5 years. Well, we look at the past 5 years, we see the same pattern. S&P 500 down here up about 90%, while Costco's is up about 225%, so it's up 2.5 times more than the S&P 500, while BJ's is up almost 350%, folks. That's 3.5 times more than the S&P 500. And remember, if you want a portfolio that outperforms the S&P 500, which 96% of the publicly traded mutual funds cannot do, so if you want to outperform the S&P 500, you want stocks that outperform the S&P 500 in your portfolio, and then your entire portfolio can outperform. Now let's look at 2002, which is very, very important. This area right in here, 2022, and that's when we kind of had a recession, but they didn't call it a recession, but the market was down, or the S&P was down 19.6%. The NASDAQ was down 34%. But look at Costco, the blue line. Costco was down just a little bit, and folks, being down just a little bit means recession resistant. So when the market was down, again, 19.6% for the S&P, 34% for the NASDAQ, look at Costco, down just a little bit during this time in here. But let's look at BJ's. BJ's was actually up during this time period when all the markets were down. So this is something to look at when we're looking at stocks, because we not only want to outperform the S&P 500, but we want to make sure that we have stocks that won't go down nearly as much, and in this case didn't go down at all, but actually went up during a period when the market went down. Now let's come all the way over here to the right, and this is 2025 so far, and we can see that Costco is up during this time frame when the market is down. So look at this, the market's down almost 10% as I'm recording this for the year, and we're looking at Costco that is up about 25% over the year. And look at BJ's. Wow, it's up almost 100% this year so far for 2025. So folks, yeah, both these stocks, this video podcast is all about BJ's, and yeah, BJ's has done very well. And when we compare it to Costco, BJ's has outperformed Costco, but Costco has also outperformed by 2.5 times the S&P 500. And this is why we have both of these stocks in our growth portfolio, folks. We love these two stocks. So, folks, we had a pretty good week this past week. We've had a pretty good year, actually, with our portfolio up for the year, while the S&P 500 is still down for the year. And we expect nothing but good things to come out of this entire year, and in fact the next 3 or 4 years, and probably going into 5 and 6 years. Yeah, we'll have ups and downs, but we think definitely the market will be higher at the end of this year and at the end of 4 years than it is right now. So folks, remember, if you want to be on this beach like Jimmy Buffett once was, then you can be sure you want to be able to invest better than Warren Buffett does right now. Okay, folks, you stay well. We'll see you back here in a couple of days.